that was easy and cheap to do before the Erie Canal and before the factories. So both of those things lead to the decline of household production, and she attributes the rise in the urban poverty to the increase in seasonal and irregular work. That conclusion is harder to support with the data. The first conclusion is easier to support with the data. All right. Topic 3. That wraps up what I wanted to do last Thursday. I told you when I walked in last Thursday that I had a lot to do. Yeah, so I had a whole extra hour's worth of stuff last Thursday. That didn't work out very well. So now we're going to fly through banking because I really want to wrap up banking today. And I know you've been doing that fun. For those of you who've had section, you've done it. For those of you who haven't, you've been doing a fun thing on asymmetric information. So that means I can run through banking a little faster. Antebellum banking and finance. And you've got other things coming. I'm going to go and buy leftover Valentine's candy on Friday so that they will have prizes or whatever activities they come up with for next week. So chocolate's always good. All right, banking and finance. Nice thick line, separate topic. Banking and finance. How were funds channeled from savers to borrowers? Remember that when we started, we said we wanted to use this context of economic growth. Output per worker is some constant A times some function of the capital to labor ratio and the land to labor ratio. When we look at banking and finance, we're really focusing on the A part right now. We're focusing on what are the changes in the banking and financial system in the antebellum years that increase total factor productivity. They increase total factor productivity because the development of banking and finance makes it easier to channel funds from savers to borrowers. All right, pictures. Here's one graph that shows you the growth of commercial banking from 1790 to 1861. When we look at Naomi Lamoureux's work, we're looking at a development that's here in the very early part. So Lamoureux, when she's looking at antebellum, New England is looking at very early in the years of banking. I'm not going to talk, I don't think at all, about this period, which is the period that's marked as the second bank in the United States, and I'm going to talk about the free banking period. So it's divided into these 3 periods. Today we have the Federal Reserve Bank, which was created in 1913. We had previously a couple of central banks. The first bank in the United States established in 1791. The second bank in the United States established in 1816. These were central banks that were similar to the Federal Reserve system that we have today. One humongous difference between the first and second banks in the United States and the Federal Reserve. The first and the second banks in the United States both had 20-year charters. The Federal Reserve, when it was created, was given a permanent charter. Having a 20-year charter means that after 20 years, Congress has to re-debate this whole issue and decide whether they're going to pass it again. Congress, go see Lincoln. Congress is no crazier now than they were in the past. And so trying to get Congress to reauthorize something is difficult. And we have now a central bank that was created with a permanent charter, so we don't have to go through these periods where we have no central bank. That's it. That's all I'm going to say about central banks. But what I want you to see in this graph is the dramatic rise in the amount of banking, particularly here in the later part of the antebellum period. What's a bank? A bank is an institution that accepts deposits, so you can go down and put some funds there and they'll hold on to them for you. They make loans. You can go down and say, I need to borrow $100 to build a new house. This was in the old days. It earns profit. That's important. Banks are not charities. Banks have as their goal maximizing profit. The goal of being a bank is to maximize profit. And they hold reserves. They need to make sure that if you come in and say, I gave you $500 last week, I'd like to have $200 of it back right now, please. They need to be able to say, yes, of course, here you go, here's your $200. And so they're going to hold on to reserves. They're not going to hold on to your whole $500 because that is how they make loans. So you go in and you give them $500, they're going to take and they're going to loan out some share of that. Today they would loan out 90%. In previous years, not necessarily so much. They're going to loan out some share of the $500 that you give them, and they're going to hold back some percentage of it, 10, 20, 30%, in case you come down and want to make a withdrawal. Banking is characterized by problems of asymmetric information. Asymmetric information consists of 2 problems. One is adverse selection. The adverse selection problem occurs before the initial transaction takes place. And it is characterized by a non-random selection of participants. So we can think about adverse selection in terms of lending. The adverse selection problem is that the banker doesn't know whether or not the people who are presenting themselves to the bank to borrow money all have an equal likelihood of profiting and being able to pay them back. We can talk about adverse selection in terms of insurance. That's where we also see it quite often. So adverse selection, for instance, in terms of health insurance, is the health insurance company doesn't know if the people who present themselves to purchase health insurance have the average level of healthiness of the population or are disproportionately sick. The incentive would be for those who are disproportionately sick to present themselves for health insurance. Because insurance companies are profit-maximizing institutions and they understand how incentives work as well, they're going to assume that the incentives are such that it's going to be just the sick people who disproportionately present themselves to walk up and say, I'd like to buy health insurance. And since the insurance company is in the business of maximizing profit, it doesn't want to extend insurance to people who are disproportionately sick. And so with adverse selection, if you don't have some way of solving the adverse selection problem, the market ceases to exist. With lending, the analogous issue with lending is that the lenders know that the people who have really good projects have lots of possible places they can borrow from. And so they realize that the incentives are for the people who come to the bank to borrow to be disproportionately the borrowers who are less likely to repay. If they don't have any way of sorting out and figuring out if you're a good borrower or a bad borrower, eventually the whole system just breaks down in the absence of the bank being able to sort who is a good borrower and who is a bad borrower. The other asymmetric information problem is moral hazard. Moral hazard refers to a change in behavior that takes place during the life of the contract. So the initial transaction has been undertaken, you have bought the insurance, you have taken out the loan, and then there's a change in behavior that is itself related to the contract. So for instance, the health insurance company writes you a health insurance policy because you passed the physical, so they figured out how to solve the asymmetric information problem, they had made you take a physical. You pass the physical, they write you health insurance, and then you start smoking again. Moral hazard. So you change your behavior because you now have the contract that will insure you and provide you with the meds when you get all those congestive diseases every winter as a result of your smoking. Hint. Sorry, I buried both my dad and my brother from smoking, so there you go. With banking, the moral hazard problem is that once the loan is extended, the borrower will change their behavior and take on some more risky behavior that's less likely to turn a profit than what they told the bank they were going to do before the loan was extended. If there's no ability to solve the moral hazard problem, once again, these markets break down. So the insurance company recognizing that you may change your behavior, if it can't find some way of watching what you do and controlling what you do, it recognizes that you have an incentive to change your behavior. It's not going to want to write insurance. The bank recognizes that a borrower has an incentive to change their behavior. It's not going to want to write some sort of loan if there's not something that they can put into the loan contract that covers them in the case of moral hazard. So how do we address it? In theory, we address asymmetric information problems, either adverse selection or moral hazard, in one or more of 3 ways. We can use government regulation, we can have fines and penalties, or we can monitor behavior. So regulation, the bank may be, if we're looking, how do I want to do this? I'm going to illustrate these in just a minute. So let me just put them up there, and then I'll come back and I'll illustrate them as we go, rather than illustrating them ahead of time. All right, so how many banks? Big increase in the number of banks. This was in the chart, the graph. This is the one table that we're using today from today's handout. The handout that you got when you came in, by the way, works for Tuesday, Thursday, and next Tuesday as well. So you don't get a new handout next Tuesday, because next Tuesday is the last day before the midterm, and what we do next Tuesday is on the midterm. So today's handout covers all the way through. So this shows you once again the number of banks, big increase in banks, particularly in the later part of the antebellum period. Where are the banks? In the 1830, when they did this in 1830, the banks are largely up here in New England and along the coast of the Mid-Atlantic. By 1850, the banks are spread out more, so that you get banks, in particular throughout New York. There's New York again. You get a wider dispersion of banks, but I want you to notice very few banks in the South. So we're going to get a dispersion of banks throughout the industrial area and into the the agricultural areas of the West, but relatively few banks in the South. In this period, we talk about banks as being state banks. It's important to realize that whether something is called a state bank or a national bank has nothing to do with where it's located or where it operates. State banks versus national banks have to do with, does the license to operate come from the state or does it come from the federal government? In this period, in the antebellum period, that is before the Civil War, we only have state banks. There are no national banks. The federal government is not issuing any charters. It's not issuing any licenses to individuals to start banks. If you want to go and start a bank, you're going to take that up with your state government. So they're all state banks. A chartered bank is one where there's a group of people who want to start a bank. They go and they get a special act of their state legislature, which is an act of the state legislature. They vote on it to grant a charter to one set of individuals to open a particular bank. In some states, they may be able to open branches. So maybe like the Wells Fargo Bank, where you have Wells Fargo Bank branches in various places in the state. Or it may be in other states, you get a charter to open a unit bank, one bank, no branching. A free bank means that the state set up a set of rules. You don't have to grease the palm of any member of the state legislature. You go and you talk to a bureaucrat who has a list of 5 or 7 things that you have to do in order to open a bank. You check off that you've done these 7 things and provide evidence to that effect, and you get a license to open a bank. So with free banking, it means there's a set of rules that the state sets up. You satisfy those rules, you can open a bank. You don't have to have an act of the state legislature. You don't have to bribe anybody. You're good to go. The free banking era starts in 1836. It starts at various times depending upon what state we're talking about, but generally when we talk about the free banking era, we talk about it as being 1836 to 1864. All right, Naomi Lamoureux, who's a historian now at Yale. She was at UCLA and then she left us. She went back to Yale. Naomi Lamoureux, who's a historian at Yale, did work on industrial New England and banking in industrial New England. Naomi Lamoureux is one of few people who works both in history and economics departments. Most economic historians either live in an economics department and they have their PhDs in economics, or they live in a history department and they have their PhDs in history. Naomi is one of the few people that has, her degree is in history, but her appointments are always joint in both economics and history. So she's somebody that really spans the 2 fields. Do you two have a question? Do you guys have a question? Would you mind going outside to talk? It's up to you. I mean, one of the two. Okay. Thank you. So Naomi looks at banking in New England. It's because she's an historian. She's doing a lot of archival research when she does this stuff. So she brings economic principles to bear and backs it up with astounding levels of archival research. So she lives in the archives for years at a time. Primary bank asset at this time is loans. The primary source of funds today is deposits. So when a bank makes a loan today, they're lending out the money that you put in when you made a deposit. In the 19th century, when she's looking at these banks, the source of their funds for making loans are stock. So if the bank is going to make a loan, the funds that they have to lend out, they got by selling stock, ownership of the bank to somebody. That's very different than today. When Wells Fargo makes a loan, they're not lending out the shareholders' contributions. They're lending out the deposits, the amount that you put into your checking account. That's very different. So at that time, it was funds that were coming from the shareholders and not from deposits. You're welcome. I'm going to skip that one. Okay. She looks at insider lending, where insider lending is defined as kinship, so family or other relationships between members of the bank board and the customers of the bank. And what she finds is this insider lending solves the asymmetric information problems, both in terms of lending and in terms of acquiring bank funds. Make sure that I know what I'm doing here. In terms of lending, the asymmetric information problem is both you don't know who's a good borrower, so that's the adverse selection, and the moral hazard problem. So one of the solutions is monitoring. One of the ways that you can monitor a borrower is be related to them. If it's your brother-in-law who's borrowing from the bank to fund his business, you're going to see your brother-in-law most Sunday afternoons for dinner. Your wife is going to go talk to his wife periodically, and she's going to come back and she's going to say, you know, I had lunch with Sally Sue today, and she told me that Harry stopped making boots last week, and now he's making some crazy thing. He's calling them pet rocks. Right? Monitoring stops the borrower from that sort of moral hazard of changing their behavior once they got the money in hand. So by having these kinship relationships, there's an easy way of monitoring, whether it comes through, kinship or other relationships. So it could be a social club or it could be a relationship through family. The other thing that the insider lending does is it solves the problem in terms of acquiring bank funds. The asymmetric information problem here is not on the part of the bank, but on the part of the rest of us. So today, 2013, people have opinions about different banks, but the opinions about different banks are based on things like customer service. So, my Facebook lights up periodically with people who've left Bank of America and gone to Mechanics Bank and are all like, row, go with your community bank. And that's mostly that's about customer service. It's not about whether or not they've looked at the loan portfolio of Mechanics Bank and compared the average riskiness of the loans in the loan portfolio of Mechanics Bank with the loan portfolio of Bank of America and decided that they're going to move their funds out of the Bank of America into Mechanics Bank because Mechanics Bank has a less risky loan portfolio. I can double guarantee you that my friends haven't got a clue what the loan portfolio of either of these banks are. They just know that the people in Mechanics Bank are nicer and they don't have those big barriers up to guard against theft. So, but at the time, back in the early period, acquiring bank funds meant if you were going to either buy stock in a bank or put your deposits in a bank, you wanted to make sure that bank was going to exist. The asymmetric information problem was on the part of the depositors or the shareholders. They wanted to make sure that they weren't putting their assets into an institution that was going to take their deposits or take the money from the shares that they bought and turn around and lend those on really risky, silly endeavors. Having these insider lending networks solves that problem as well. Because if the people who are buying the shares of stock in the Suffolk Bank are all cousins of each other, then once again, the shareholders can monitor now what the bank is doing with their funds. So it provides a way, again, of monitoring, of following what's happening with the funds, and allows for people to feel comfortable in either putting deposits in the banks or in purchasing the stock. Now, a lot of people, when they hear that this is a book on insider lending, think, but isn't insider lending a bad thing? Because we hear about insider lending and we think, oh, that's a bad thing. People go to jail for insider lending today. That's a different definition of insider lending. The insider lending that Lamoureux is talking about is having these social networks, these kinship connections, or what today we talk about social networks, that connect folk between the borrowers, the bank, and the funding of the bank. And so she argues that it was not bad in this particular context. She argues that it didn't lower the availability of credit, it didn't hurt the soundness of the banking system, that it didn't decrease the demand for bank stock, all things that we might worry about today with insider lending, that it didn't harm growth and development in New England. Now, one of the questions that Lamoureux does not answer, however, is whether or not this network of insider lending meant that the activities that took place in New England were less diverse than they might have been if it had not been an insider lending network. So by having insider lending, so the kinship and the social network, we wound up with a New England area that was very heavily concentrated in boots and shoes and textiles, and had very little diversification in its manufacturing. A question that cannot really be answered. I mean, people can try to do the counterfactual, but it's a pretty hard question to answer. Maybe it could be answered, I don't know. But the counterfactual is, what would the diversification of manufacturing have looked like in New England if they hadn't had insider lending? If the lending had gone not simply to your brother-in-law, but to people down the street that you didn't know, who wanted to try something different, who didn't want to stick with boots and shoes and textiles, but wanted to manufacture pet rocks in the south of Boston and see how that would go. What New England found was that by being heavily invested in boots and shoes and textiles, 100 years down the road, they paid the price for that. So when the demand for boots and shoes and textiles shifted to international demand, when there was import substitution for boots and shoes and textiles, New England was decimated. Had they had a more diversified manufacturing base to begin with, they might not have been as decimated in the 1970s as they were as a result of being so heavily invested in boots and shoes and textiles, which might have been a result of insider lending. One more slide. Cotton South. The Cotton South. I just pointed out that there were very few banks in the Cotton South. That's because in the South, instead of relying on banks, they relied on men that were known as cotton factors. So these were individuals who were agents. Typically, they were agents of financial institutions in England, and they would work one-on-one with individual cotton growers in the South, particularly with the large plantations. So this is not, we're not talking here about the family farms, and we'll look at some numbers on this starting on Thursday. The cotton factors would secure credit for the growers. They would take care of getting the cotton to market. So they were both providing the finance and they were providing the distribution end of things, but they substituted for banks. And so there wasn't a pull, there wasn't a demand for banks in the South because there was this whole system of cotton factors that linked the cotton farmers up, linked them up to financial institutions in England, gave them ways to export their products, and there was not a demand for banks in the South, and we didn't get banks in the South, and it comes back to bite the South after the Civil War, in the postbellum period. The piece I didn't get to is the free banking era, and I'll think about, I want to maybe take 4 minutes at the very beginning of Thursday to do that, or maybe not. Y'all have a great day, and I'll see you on Thursday.